Billionaire investor David Tepper has around 40% of his portfolio in these 4 growth stocks. Now, if you don't know who David Tepper is, here's a quick intro. David Tepper is the owner of Carolina Panthers of the NFL and Charlotte FC of the MLS. Tepper is the founder and president of Appaloosa Management, a global hedge fund based in Miami Beach, Florida. There are 39 stocks in the portfolio and the portfolio value is at $5.6 billion. Now, before looking at the 4 stocks and the overall portfolio, if you enjoyed this type of videos, leave it a thumbs up, subscribe if not. We'll really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, if we look at the Appaloosa Management portfolio, we can see very familiar names, right? Number 1, Meta Platform, then Microsoft, Amazon, Nvidia, Uber, Alibaba, Alphabet, AMD, and Intel to sum up the top 10 positions here. So Meta Platform is at 11.57%, Microsoft at 11.30%, Amazon at 10.61%, and Nvidia at 6.92%. Now, they did reduce Meta by 5.13% last quarter. They increased Microsoft by close to 4%, increased Amazon by over 5%, reduced Nvidia by 22.9%, and Uber by 17.24%. Actually, if you look at the semiconductors, if you look at Nvidia, AMD, Intel, and Qualcomm, they've all been reducing the semiconductor exposure by quite a lot. They've added 20.83% to Alibaba. If you remember the super investor video, we did see quite a lot of those investors adding to Alibaba or actually opening up a position on Baba. Then as for the rest of the list here, they did open a position in Oracle. They added a big chunk to Caesar Entertainment, 47.54% increase there. They opened a position in UPS, in HCA Healthcare, and then here all the tiny positions under 0.5% of the portfolio. So it's pretty safe to say that this portfolio is heavily focused on tech, high growth companies, and the largest companies on the planet. Yes, there is no Apple or Tesla to be seen. So let's start off with number 4 here, and that's Nvidia. If you look at the valuation for Nvidia right now, it's still cheaper than its 5-year mean. The stock is up 240% or so year over year, but the company has grown so fast top and bottom line that despite, yes, just purely looking at the PE, 36.2 times, without actually looking at the business performance, the growth rate, you might say, oh, this is very expensive. But actually, not that much. Of course, as we've seen at the start of the year, it was still quite cheap, 25.3 times. And since the start of the year, the stock is up 81%. If you look at EV to EBITDA, 30.7 times. Price to sales, that's the only one where I say, okay, that's very expensive, close to 20 times. But then if you look at price to free cash flow and especially price earnings to growth is basically telling you what the expectations are, future growth are with regards to earnings growth, and that sits at 1. If we look at the average analyst price target, that sits at $986, representing close to 10% upside from the price we're at today. If we're looking at what the analysts are expecting for the coming fiscal years, for the fiscal year 2025 for Nvidia, huge growth, still revenue increasing 82% year over year with EPS growing 91.9%. Then for the coming fiscal years, it's a bit lower, but of course these numbers can be revised up or down. So fiscal year 2026, 22.16% year over year growth for sales, same for EPS. Then in fiscal year 2027, sales and EPS growth of around 17 to 18% year over year. The company is obviously also buying back shares and pays a tiny dividend here, a dividend yield of 0.02%. Moving on to the next one, and that's my personal second largest position, and that's Amazon. Now, Amazon also, despite being up year over year 91%, year to date up 23%, it is cheaper than its 5-year mean. Now, why is that? Well, because these metrics here are telling us that, whoa, this company is growing top and bottom line, and bottom line is now growing quite fast, as you will see in just a second. So forward PE 44.6 times, EV to EBITDA 15.2 times, price to sales 3 times, price to free cash flow has now completely collapsed here, which is a good thing, is at 60.6 times, price earnings to growth at 1.92. With regards to the average analyst price target, that sits at $208.6, representing around 11% upside from the price we're at today. Then as you can see here, these are the analyst expectations for the coming fiscal years. You can see that sales growth is expected to be around 11 to 12% for the coming fiscal years, including fiscal year 2024. But like I said, the profitability side of Amazon is just starting. If you look at fiscal year 2024 expectations, EPS growth of around 45%, followed up by around 27 and 29% for fiscal year 25 and 26 respectively. So we're seeing Amazon growing. We're seeing Amazon growing in a profitable way in all of their business segments. Up next, we've got Microsoft. Microsoft now are the only company over $3 trillion, $3.14 trillion actually. That company is up 12.6% year to date, up 50% year over year. Now, Microsoft, if you look at valuation here, yes, it is more expensive than its 5-year mean. Forward PE currently sits at 34.6 times, EV to EBITDA 23.2 times, price to sales 12.1 times, price to free cash flow 46.1 times, then price earnings to growth at 2.32. So yes, you could say that buying a Microsoft right now is buying Microsoft at a big premium. But you're also going to buy Microsoft right now at probably its strongest point ever. Whether it's cloud, AI investments, SaaS, gaming, you name it, Microsoft is at the forefront of close to all of those industries. If we're looking at the average analyst price target, that sits at $471, representing 11.3% upside from the price we're at today. Then looking at what the analysts are expecting for the coming fiscal year. So for fiscal year 2024, sales growth of 15.3% year over year, EPS growth of around 19%. Then in the next 2 fiscal years, you're getting around 15% growth on average year over year, top and bottom line. And of course, with Microsoft, you're also getting paid a nice little dividend plus buybacks. Then the last one here is Meta. Meta has had quite a turnaround from a business perspective, but also from a stocks perspective. Year to date, that stock is up 44.7%. Year over year, the stock is up 140%. Yes, if you look at the valuations right now, forward price to earnings, EV to EBITDA, price to sales, price to free cash flow, it is more expensive than its 5-year mean. But actually looking at those numbers, it is still quite the cheapest of the bunch. Forward PE, 25.5 times, EV to EBITDA, 13.8 times, price to sales, 8.2 times, price to free cash flow, 29.7 times, price earnings to growth, 1.14. In my opinion, still relatively cheap. If you're looking at the average analyst price target, that sits at $532, representing around 4.2% upside from the price we're at today. And if we're looking at what the analysts are expecting for the coming fiscal years, in fiscal year 2024, sales growth of around 17.5% year over year, EPS 34.6% year over year growth. Then for the coming 2 fiscal years, sales growth of around 12 to 12.5% for each and every year, and EPS growth of around 16 to 15% year over year growth. Now, Meta, we know, has been investing quite a lot in AI. They've had their weakness, of course, we know, when the stock was under $100. Huge weakness, we've talked about that on the channel, but it turned it all around. I think they're back and back much stronger and much more profitable than ever before, despite burning quite a lot of billions of dollars on Reality Labs. So overall, these 4 stocks make up around 40% of David Tepper's portfolio. And of course, we've seen the other holdings, pretty much a high-tech growth investor. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.